From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Wednesday, December 22nd. Here are the top market stories that we're following for you at this hour. Home stretch, stock stable, volume thins, yield go nowhere. Dollar trades a little heavy. Are we late cycle? How do you position in 2022? And the testing turmoil. The Biden administration is buying 4 million courses of COVID treatments and shipping free tests to Americans. We're going to talk to Mark Goldberg, CEO of Rapid Test New York City, to find out what the problems actually are. And supply chain solutions. President Biden meets with CEOs on fixing lingering supply chain issues. We're going to break down that outlook for 2022. From New York, I'm Alix Steel, my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I've said it all week. I'll say it again. The next 24 hours, 48 hours. How do you pay attention to the price action? Volume quite thin.
I don't think you pay attention to the price action at all. I think you just basically ignore it. As you say, I think we're in roll-off now. We're heading into the holiday season. Everybody's more interested in finding tests than they are in trading this market. And I think that's the narrative. Monday was obviously a different story. We got a lot of volatility around Monday, but ever since then, we've been going lower. So I don't think there's much signal right now from these markets. As I said earlier on today, I'm not even sure there's that much noise coming out of them either. Let's talk about the data we are getting and what it tells us about where we are with the US economy right now. Existing home sales numbers hitting the tape as we speak. They are up on last month, but down on expectation. So they come in at 6.46 million. That's the headline number. The expectation, 6.53. We dipped recently during the summer and have now started to re-accelerate on existing home sales. But maybe the pace of that acceleration starting to slow a little bit. Month on month, we come through at 1.9. That's up from 0.8 last time. But the market, the economists, looking for 2.9 there, Alex.
We're also getting consumer confidence, and it's actually pretty good. I mean, consumer confidence for December up 115.8. Expectations also almost hitting 97. Present situation looking really good. You wonder how much Omicron is factoring into this or not. But this also echoes something we saw from the third quarter GDP numbers, and I appreciate that that was very much backward looking. But still, inflation is higher, but consumers are still buying stuff at the end of the day.
Yeah, they are. But haven't they got all the stuff they need? I think that's one of the key questions that we need to figure out going into next year.
I know you haven't. No. Is
I
always
know you
no.
haven't. But many people may have reached their limits of how much stuff they're actually prepared to buy. And actually, if you take a look at the savings rate, certainly as a percentage of disposable income, it's coming down pretty sharply. So you're seeing that here in the UK as well. We're coming into next year with less fiscal support, less monetary support potentially for the US consumer. But the jobs market is still pretty hot. You take a look at the JOLTS number, plenty of opportunities out there. So where are we in this economic cycle? This year has been incredibly strong. We're seeing incredible returns being delivered for investors. Does next year continue with that? Do you need to start to shift the way you invest as we maybe kind of start to see, maybe in the distant future, the end of this cycle? Well, let's try and answer that question. Our guest that is going to do that with us is Karen Dawson, Field Point Private Chief Market Strategist. Karen, great to see you. Let's try and figure out where we are. Are we late cycle?
Well, I think we have to start by defining what late cycle is. To us, late cycle means that you're seeing decelerating growth at the same time that liquidity is tightening. And that certainly could start to be the setup as we go into 2022. And then we have to look at what the market is telling us about where we are in the cycle. And quite interestingly, we have seen late cycle types of sectors start to outperform over the last 3 weeks. So you think of really defensive things like staples, utilities, healthcare, REITs, all showing more signs of life than they have really since the days of the March 2020 meltdown. So then what we look for is signs that cyclicals are starting to underperform. And a great great thing to watch here is the relative performance of discretionary versus staples. So discretionary being risk on, very cyclical, versus staples, which is risk off and defensive. And we've actually seen the most negative volatility in that ratio since March of 2020. So we're starting to see signs that the market is moving late cycle or starting to want to get more defensive and take a little risk off the table. So the way that we would like to play this is to really focus on quality. As we move later in the economic cycle, quality becomes increasingly important. So we want strong free cash flows, strong balance sheets, good ability to return capital to shareholders, because that kind of becomes the ballast in the storm when economic volatility starts to pick up.
So, Cameron, good to see you, by the way. We also truly appreciate your Ninja Turtles to the side there. So we appreciate you bringing that
Turtle power
to us. We dig it. So it's interesting that you bring up that kind of rotation, because Guy and I have been talking about this for a while, that do we actually take any of the price action recently seriously? And I want to point us to an RBC investor survey that they actually released today. And in it, what stood out to me is that the consensus actually is confusion. Lori Calvasino was saying that we see evidence of division on a number of the issues that equity investors are grappling with, suggesting to us that the mood of the market is perplexed and conflicted rather than bullish or bearish. What's your assessment of that?
I think that is actually a very fair assessment, and likely how the rest of 2022 plays out is this sideways chop. So we aren't seeing signs that we've seen really big breakouts in utilities or staples relative to the market. So we're clearly not in new relative uptrends, which would tell us to be a lot more defensive and seek shelter. However, this is the most we've seen of a rotation into these more defensive assets that we've seen really since March of 2020. I think the other really important question to ask is, has tech become kind of the stealth defensive trade? So tech is usually considered a cyclical and a risk on trade. But if you look under the surface, tech actually has a lower beta than utilities, and it has more earnings counter cyclicality than utilities. Tech grew earnings by 7% in 2020 compared to utilities, which saw earnings decline 20% in 2020. So how much are we already seeing this shift to trying to find stability, find security in more defensive areas, which might actually under the surface include those technology names?
Cameron, do I seek out dividends?
Yes, definitely. Because when returns move lower through the cycle, as we get to the later parts of the cycle, we do expect equity returns to be much lower in 2022, which means that the dividend component becomes a larger part of your total return. Also, investors will look to see that kind of income side of things when there's more uncertainty about the price return. So we think that companies that have really good ability to not just pay dividends, but grow those dividends are names that will perform well into 2022.
Cameron, what is your assessment of volatility? It's been confusing to look at the correlations recently, and market action has been pretty whippy. And I'm wondering, how do you either protect yourself against that, like cash, treasury kind of thing, or how do you play it?
So volatility is something that we think that makes cash more attractive, because it provides you optionality when you have cash. Yes, you have the opportunity cost of not being able to be invested. And of course, if you were in a lot of cash starting this year, it certainly hurt with the market up almost 25 or over 25%. But having a little bit of cash in a world where we do expect volatility to pick up does make a lot of sense. There's one good reason why we could see volatility increase as we go into 2022, and that's because leverage within the market is actually quite high. If we look at trader leverage, whether it's margin loans or the number of call options that have been written on a bullish side of things for the market, they've increased substantially. And when those unwind, it can cause a negative catalyst to have a much larger reaction in the market, meaning that negative volatility moves happen kind of in a blink of an eye. So having a little bit of cash or more cash than you might normally have does make sense so that that you can step in and take advantage of that volatility, which could move a lot faster than even what we've seen in the past few years.
Yeah, we've been hearing that, kind of have that dry powder. All right, Cameron Dawson of Field Point, hang tight, you'll be sticking with us. We're going to take a look at one of the biggest market themes this year, that supply chain crunch. How is all this going to play into 2022, and how do you deal with it in your investment portfolio? This is Bloomberg. Live from New York, I'm Alix Steel with Guy Johnson over in London. This is Bloomberg Markets. So in about 20 minutes' time, President Biden is going to meet with private sector CEOs at the White House to discuss global supply chain bottlenecks, an enormous issue for 2021. Joining us now, Brooke Sutherland of Bloomberg Opinion, and still with us, Cameron Dawson, Chief Market Strategist of Field Point Private. Hey, Brooke, this was the story, really, of 2021, and I'm wondering if we're going to clear the issue in 2022 or what the lingering problems are going to be.
I think you should get ready for the sequel on supply chains, that it is still going to be a top story in 2022. We are making some progress around the edges. Rail pickups at the ports in particular have gotten much better. And, we're doing a little bit better job of clearing out those empty containers, but there's still a lot to be done. I was talking with Flexport the other week, and they have a tracker that looks at how long it takes goods from the point they leave a factory in Asia to the point where they're picked up at a port and taken to a warehouse. That used to be about 45 days. It's now more than 100. And so I think we're making progress, but the important thing to know is that progress doesn't mean the problem is fixed. What's really driving this is that the U.S. consumer just keeps ordering so much physical stuff. We've seen spending come back for airlines, for entertainment, for restaurants, taking a slight dip now because of Omicron, but they're still buying lots of furniture, home improvement supplies, and that's what's really clogging up a lot of these ports.
Brooke, post-Christmas, what are the chances, and I think we probably need to be specific here about what we're talking about, is there a chance that certain sectors are going to go from famine to feast? All the stuff that's on the boats right now is going to come off the boats, it's going to go into warehouses, and nobody's going to want it.
I think there is a risk of that on the retail side. And you're right that it's important to sort of draw a distinction there. The big retailers like Walmart and Target really pushed to build up a ton of inventory heading into the holiday season. And we've seen some weak numbers in terms of Black Friday spending, Cyber Monday. Now it's anyone's guess, was that a result of people just shopping earlier because they were concerned about the supply chain, or are people feeling the pinch of inflation and some other economic concerns that they're just not spending as much? But especially for the smaller retailers, I mean, if your goods are still on a boat outside of the port of LA, you're not getting them in time for Christmas. And you're probably going to be looking at, selling them at a big discount just to try to sell that inventory. Now, on the industrial side, what companies are saying is that they are selling literally everything that they can push out the door. And that, inventories may be a little bit high at the distributor level, but that just reflects the very strong demand that they're seeing. Now, we'll see if that thesis plays out, but I do think on the industrial side, there's some structural reasons why demand may stay very healthy throughout 2022 and potentially for a few years down the road.
I just have the anecdotal story, guys. I ordered a pair of sheets April 25th, and they just got to my house yesterday.
A pair of sheets?
A pair of sheets. Well, like sheets, just sheets. I was like, I don't.
You bought sheets?
They're just straight up cotton sheets, and somehow it took like a million months. I don't know what that was about.
I think it's super interesting because, you can go to a Walmart or a Target and you can get a lot of stuff these days. It's just that they're sort of changing the way that they stock goods. So they've prioritized best sellers. And so your sheets probably weren't a hot item. And so, they didn't prioritize getting that on the boat and getting that to you. But you have this sort of weird dynamic of full warehouses, but also shortages of Alix's sheets.
I have to wonder, though, where I ordered them from and go back on that front. Cameron, I want to get your take on this. What is priced in, say, just take the industrial sector and then we can take the retail sector, what's priced into this and how can you make money off of it?
So we think that if you look at the industrial sector and kind of look at the relative performance, it might look on the surface that the sentiment around industrials is quite poor. But a lot of that is really just in the aerospace and defense side of things, which is a very large weight in the sector. So if you look at all the manufacturing companies, whether they're multis, machineries, services, and the transports, you actually see a lot of these stocks trading near peak multiples, even though the PMI is also at or near a cycle peak, which has never been necessarily a great setup for forward returns. So really to see a better improvement in the industrial sector would have to come from A&D doing better next year. But we are concerned that some of these manufacturers, which have been benefiting from extremely strong pricing power, ability to pass all those costs on through to those customers, if growth does start to slow with the PMIs, does that pricing power start to fade? And then we start to have a little bit more margin trouble.
Okay, well, that'll be certainly something to watch out for. Margins are going to be, I think, one of the big themes going into during next year. Cameron, though, just taking a step back, what I've heard so far, though, is that while Alix may be able to get a pair of sheets more cheaply somewhere in the new year, i.e. we're going to see some maybe retail discounting, nevertheless, the inflationary narrative is going to stay with us. Brooke was talking about this lasting for years, potentially. What does that tell us about the trajectory we're on in terms of Fed policy, in terms of the need for authorities around the world to tamp this down?
So it certainly argues that inflation will stay elevated at least into the second quarter of 2022, where that's when we start seeing the tough comps start to kick in. Really, that's when May of 2021, we saw really high inflation starting coming through. So that should be when the overall headline number should moderate. But where it moderates to is the big question. So right now, there's an expectation that it probably doesn't go back to those pre-pandemic levels because of all of these sticky issues that we've been talking about, whether it's supply chain issues or housing or wages for that matter, all keeping inflation higher than the 2% targets that a lot of the central banks have. But there's something interesting here, which is that if you look at the market-based inflation expectations, they actually show that the market is pricing in long-term inflation a lot closer to that 2% number. The five-year forward is only at 2.13%. That's below where it was in 2018, and actually below where it was in May of this year when we just started seeing some of these higher inflation prints. So the market clearly believes that inflation, those things driving higher inflation today, even though they're sticky, they're not going to stick around in the long term, or that the Fed will be able to step in and really quell that inflation over the long term. And that explains why we can see these 40-year high readings in inflation and yet be near 40-year lows in long bond yields, because the long-term interest rate and long-term inflation expectations are still that inflation will moderate back to that 2% level or close to it, which really does remain to be seen, of course, because of these sticky factors.
But you can even see it in the expectations from the conference board earlier that the expectations are doing really well despite the higher prices. The outlook is all right. Hey, Brooke, I wonder, when you talk to a ton of companies, particularly those that already have some slim margins, and I'm wondering how they're going to deal with inflation next year and what they're saying about it, because they've already done a lot of the stuff. They've already sort of trimmed what they could, trimmed the fat. What are you hearing?
You know, I think to Cameron's point on the industrial side, we've seen incredible pricing power out of these companies. I mean, they've pushed through, 3, 4, sometimes price increases already this year and are looking at additional price increases in 2022. To her point, I mean, it depends on what demand looks like and if you can continue pushing that pricing level. But I will say there was a lot of concern heading into third quarter earnings season about industrial margins. You had a lot of CEOs out there giving almost doomsday predictions around the supply chain and labor shortages and what have you. And margins were fine. They were really actually pretty good. And, Bloomberg News did a fascinating analysis showing that outside of the financial sector, corporate margins are at, the fattest since the 1950s. And so I think that, for the bigger companies, they are finding ways to manage through the supply chain challenges, which does give me some encouragement because, while I say that these challenges are not fixed, that we probably have seen the worst of them and they are easing incrementally. It will take time to work through that, but these companies have faced the worst of the supply chain challenges. and they've managed it, that is encouraging. Now, what is stickier is on the labor front. And we are seeing a lot of these companies having to pay up for wages, but in many ways, that's what they should be doing because they're doing very well, and they should be passing that on to their workers. No,
fair enough. All right, guys, thanks a lot. Really great conversation. We appreciate both of you. Cameron Dawson, Field Point Private Securities Chief Market Strategist, and Bloomberg Opinion columnist Brooke Sutherland. Thank you very much. While we were talking, New York City Mayor Bill de Blasio was speaking in a briefing. Two things to know. One, the New York City is going to add about 7 COVID test sites and hand out rapid tests. 7 COVID test sites. I have to wonder why we're looking at just 7. I mean, when I say that lines are around the block to get tested. Also, the mayor is saying that public hospitals will restrict visitations during the COVID spike as well. We'll keep you updated on any other headlines as they cross. Guy?
Yeah, they just got to get more and more of this stuff. You can make smarter decisions if you know what's going on. If we're not going to do it nationally and have lockdowns and things like that, individuals have got to make smart decisions.
Exactly.
Testing. Okay, what are we going to do next? CarMax, which is the biggest, I understand, the biggest used car retailer in the United States, something Alex probably knows about, posting blowout results. We're going to have more on that story next. This is Bloomberg. Used car sales, at least. CarMax out with numbers a little bit earlier on. This is the biggest used car retailer in the United States. These are third quarter numbers. The EPS figure certainly beating estimates. What I think is interesting, though, is the stock is rolling over, and rolling over reasonably hard at the moment, as you can see as we come through this session. As the line says, maybe acquisition costs a factor. You've got to go out and find those vehicles. You're paying more for them, and how much of that can you actually pass on? But that's a factor that the market certainly is looking at. We are down today. 2 days, down by 3.4%. Kriti Gupta with all the details.
Yeah, Guy, it's supposed to be a blowout quarter, and it was great. CarMax was doing great in the pre-market. Those shares were rising. But then you look at kind of what's underneath the hood, because, yes, used car sales have been on a tear. Yes, that's really helped with CarMax's bottom line. But here's the thing. As you start to charge those higher prices, sometimes it's not enough when you need even more inventory. And it's those storage costs, those acquisition costs, to your point, that are starting to dig into those margins. And we know margins have been the 2021 story. So that's why you're seeing the stock roll over. But let's just talk about revenues for a second, because like I said, used car sales have been thriving, and revenues for CarMax in particular have been as well. $8.53 billion on their balance sheet, and that's going to be huge, not just for CarMax, but for car rental companies broadly, especially when you start to see some of these variants start to emerge as well and start to see air travel actually decline. What do you do instead? Well, perhaps you get on the road and you drive, and that's going to be a really key piece of it as we start to see some of those auto shortages continue when it comes to buying a new car. Let's just take a look as well as those used car sales. This is, of course, those new used vehicles, and you have seen that kind of momentum, that demand for them. It has consistently risen, not just for 1 year, but for 2 years in a pretty high kind of beat. The question is, will that momentum slow? And right now, it doesn't look like it.
All right, Kriti, thanks a lot. Really appreciate it. Kriti Gupta joining us there. I should point out, Guy, based on that chart, I bought Jasper at not the top of the market. I bought a used car in the summer, and we're all like, that's it. I called the top. It's over. And it's not true. I did not.
No, it's been amazing. And you do wonder whether this story carries on.
Yeah.
Still can't get the chips, still limited production. It's going to have a long-lasting effect. You want to buy a used car in 2 years' time, you're going to be affected by what's going on now.
All right, coming up, we'll talk venture capital. Saw record fundraising this year. Will it continue? With Sheila Patel, B Capital Vice Chair. This is Bloomberg.
So we're an hour into what is a super interesting, riveting session on Wall Street. Not. Kriti Gupta is here to tell us what is going on.
Yeah, Guy, you got that right. We are moving higher, but it is moderately higher on those major indices. This is after, of course, yesterday's big rally, and we have been seeing some pretty extreme volatility levels. Of course, maybe a bit subdued today. We're heading ahead of that holiday, so lighter volumes, lighter trade. But it is really beneath the surface where we have been seeing a lot of that volatility. On the index level, we look pretty strong, but if you flip up the board here, I want to look beneath that surface, and I want to look at tech because that's where we've been seeing these big moves. And in December alone, we've actually had 4 times where we've moved over 2% either way on this index, and it really speaks to the volatility that we're seeing, and especially in these more speculative areas of the market. So we've seen investors not really knowing where to go to hedge. We've seen defensives really outweighing their cyclicals over the past month. Now, Guy, where they are certainly not going, that is in some of your more speculative areas of the markets, and I point to your SPACs and your IPOs because they have been hurt pretty badly over the past year. If we can flip up the board, I want to take a look here at the ARK Innovation ETF, down 27% over the past year. The Renaissance IPO ETF as well. It speaks to investors really their waning enthusiasm as we see more volatility, and a lot of deal makers saying expect more to come in 2022, Guy.
Okay. Alex? Ritika, thank you very much. Alex, that's probably what I should have done then.
Guy, thank you.
Okay.
But I think it's a really good setup for the amount of money and the speculative money that has been in the market and kind of what's happened to it, say, in the last 6 months. So let's dig into that a little bit more from the venture capital side and what the year ahead looks like. We're going to bring in Sheila Patel, B Capital Vice Chairman. She has 30 years of experience in financial markets and investment. Most recently, she served as Chairman of Goldman Sachs Asset Management. Sheila, it's so great to see you. It's been such a long time. Congrats on the new gig. I know it's not that new anymore, but good to see you.
It's great to see you, Alex. And yeah, it's been a fabulous new gig and a lot of fun to be in venture and growth.
So let's talk about it. So we just had a great sort of setup in terms of the ARK Innovation, the SPAC ETF, the IPO ETF, all really down hard this year. That momentum really faltering. In the private market where you are, what does it look like?
Look, the momentum continues. And in some ways, I hearken back to my old days on the trading floor in the 90s. And I feel like some of the same strategies we got used to in the public markets are being applied to the private markets in terms of momentum, in terms of how portfolios are being built, and in terms of the kind of boom, boom movement of being in anything and everything. So it's a fascinating time, but it's also a time where investors want to see us act with a bit of decision making and a bit of caution. And I think that's very important for the year ahead.
What does the year ahead look like to you?
Look, I think the year ahead continues to steamroll when you talk about tech. There is so much development coming, and the areas in which we work are kind of the non-sexy, boring areas. The areas where old industrial companies digitize, where industries and areas like healthcare that have been innovating so much and forced to innovate by the pandemic are now adapting those innovations and realizing they can go even further to drive efficiencies. And so what's interesting to me about the sectors we work in, enterprise, healthcare, thinking about what's going on in fintech, some of these industries need to modernize regardless of where the economy goes. And so there's so much concern about inflation, obviously coming from the public markets and coming from a huge platform. I think about that a lot, but these innovations will save companies money. So I think they continue regardless of the economy.
So Sheila, just let's dig into that a little bit more. I'm wondering if inflation does stay elevated and the Fed doesn't really succeed in bringing that materially down next year, does that dent momentum even in the short term?
Look, I think if inflation is not brought under some kind of control, that certainly will concern people and could dent momentum. That said, I think what's driving inflation continues to be the debate among investors. Is it a temporal situation or is it a long-term ongoing issue? We continue to have supply issues. There continue to be labor shortages. There continue to be startup issues within the economy globally, not just in the US. And that's expected. When you go to the airport and there's a huge snowstorm, it takes a while to start things up and have it be efficient again. And that's exactly what the pandemic has done on a grand scale to global supply chains and to the global economy more broadly.
Why would you want to invest in private next year? Let's assume that volatility goes up in public markets. Does the lack of mark-to-market in private markets provide you with a better option next year as volatility starts to pick up elsewhere? Or do you think you're going to see similar volatility in some private markets as you're seeing in public markets?
Look, I think you'll actually see some volatility in private markets as well, and you already have. I think coming to the private markets and expecting that it's just about the mark to market is limiting in your thinking. When you think about the private markets, they've expanded so much. It feels like the public markets in some way in terms of the breadth of the sectors, the number of companies, the amount of things going on. And that's the trend we've seen, when over the past 15 years, the S&P 500 has had a huge turnover in who's captured in that index. And so much of what's going on in the economy is captured in the private markets. But you see volatility depending on the sector. I would expect volatility in the consumer areas of venture and of growth of the private markets the same way you would in the public markets, because it's hard to predict where consumers go. And we have a lot of uncertainty around the pandemic and other issues driven by it.
Sheila, I think that when we talk to any investor, we talk about the 60-40 portfolio. Everyone always says for the 40 portfolio, you need to find different kind of assets. You need alternative assets. And I wonder, what role do you think venture capital is going to play in that in the future? Like, what are you noticing in terms of the type of investors and the type of money flow?
Look, I think, venture and growth are both areas that have become more mature. And as a more mature area, you see experienced investors, you see large institutions, sovereign wealth funds, U.S. pensions, the super funds from Australia, et cetera, engaging in this space. They force a discipline, they force a mark to market, they force, I think, some great things within this area of investing and within alternatives more broadly, because that discipline and that mark to market and that questioning a strategy will be what's needed to keep maturing this space. And I think it has matured incredibly over the last few years. And you see that in the deals being done, you see that in the sectors being explored, and you see that in the companies being brought to market that are sustainable. We love to talk about the ones that are a bit nuts or that go a bit crazy, but there are hundreds of companies that are doing great work that are being brought to market by venture.
In terms of what are the big long-term trends you see that investors can kind of latch onto right now, we hear more about Meta. That's going to be clearly a theme into next year. Sustainable energy, clearly a huge theme going forward. Which of these trends do you think are going to outperform? Where do I want to kind of hitch my money to in terms of making sure that I'm along for the ride?
Well, I'd say a couple of areas we're spending quite a bit of time on, and we just spent some great time with our strategic partner, BCG, exploring some areas where we think people need to focus and where we think there's opportunity. I think climate tech and overall climate change is a big one. And in our conversations and debates about investing in the year ahead, this is an area where we see a huge amount of opportunity, a lot of capital already flowing, however. And so the need to really understand what the technologies are and where innovation's being driven. These are areas where actually Europe and even Asia are somewhat ahead of the US in terms of innovating, and we have to be global in our footprint, which of course BCG and B Capital are. I think a second thing that we need to think about is that digitization of old industry. BCG does a survey every year, and this year, 35% of the companies they surveyed are happy with their digitization. That leaves a big swath of companies that have not been getting themselves brought into the new age and applying technology effectively. And that's gone up only marginally from last year. It was 30% last year. So a huge number of industries need to be brought into the 21st century and beyond. And I think that's an investing area that will stay very sticky and offer a lot of opportunity.
Sheila, it's great to catch up again. Thank you for your time today. We really appreciate it. Look forward to seeing you again soon. Sheila Patel, B Capital Vice Chair. Thank you very much indeed. Alix?
Oil inventories coming out about 9 minutes ago. Oil taking a leg higher, in part because there was a big, super big draw in oil inventories, about 4.7 million barrels, a large part of that the U.S. Gulf Coast. Also have to say, implied demand for gasoline and distillate also super strong. You did get a gasoline inventory build, but the demand still coming in a bit strong there. And you're seeing WTI responding kind, up by 1 percentage point. Also helped, I should say, by the weaker dollar. All right, coming up, New York City hospitals now restricting visitations during COVID. We also learned that New York City Mayor Bill de Blasio is adding 7 new testing sites as those queues get longer and longer. We're going to break down what the problem is with Mark Goldberg, a Rapid Test NYC co-founder and CEO. This is Bloomberg.
This is Bloomberg Markets. I'm Rishka Gupta, and you're looking at a live shot of the principal room. Coming up, Eurasia Group President Ian Bremmer. That's on balance of power at noon in New York. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Rishka Gupta. President Biden is hosting a meeting at the White House this hour to discuss global supply chain bottlenecks and the COVID-19 pandemic. The White House says members of the president's team are on hand, as well as participants from the private sector, including the CEOs of FedEx and Gap. Israel says it will give a fourth dose of coronavirus vaccine to people over the age of 60 and medical personnel. It's the first country in the world to do so on such a widespread basis as the Omicron variant barrels across the globe. Prime Minister Naftali Bennett has told authorities to prepare for a nationwide inoculation drive. But Israel's public health chief says there's not enough data yet showing the efficacy of a fourth dose. And Chile tops Bloomberg's COVID resilience ranking in December. It reflects the broader recovery of the South America region, helped by warmer weather and rapid booster shot rollout. Southeast Asia continues to populate the bottom of the ranking as the region lags in vaccination and reopening. In December, Vietnam took over last place from the Philippines, where restrictions and infections have eased. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg. Guy.
Veronica, thank you very much indeed. New York City public hospitals are restricting visitations during the COVID spike. Mayor Bill de Blasio also said that the city is adding 7 new COVID testing sites and handing out rapid tests to the public. Joining us now, Mark Goldberg, Rapid Test NYC co-founder and CEO. Mark, let's deal first of all with that news from the mayor. 7 new sites opening up. How big an impact will they have?
I think that will definitely help out with all the lines. You know, we see massive lines in demand right now. But even though that Bill de Blasio is opening up new 7 testing sites, I just read today that 13 city MDs are closing down. So even though we have these new 7, 13 closed down, which is going to add even more demand. But, you know, we definitely need more testing sites. We definitely need more help to help with the lines and to hopefully ease up the laboratory's capacity.
So, Mark, you have 2 sites in New York City, and then you have another one open right on Madison Square Garden, MSG. And I'm wondering, how's it going? What's the biggest, what's demand are you seeing? How are you managing it? What's the biggest problem that you're having right now?
So the demand is out of control. We have, been doing more tests than even during the peak of the pandemic last year. To fix this issue, we had to hire more staff, extend our hours, order more machines from the laboratories and just, extend everything to try to make the lines go as fast as possible. But, there's still, at every testing center, there are going to be lines for now while this Omicron is spreading like wildfire.
Yeah, Senator Schumer now saying he's asking FEMA for 100 mobile testing sites in New York City. In terms of the logistics around staffing, you talked about those sites that have shut down. How big is it? How big a problem is it to get staff right now? And how problematic do you think it's going to become going forward as more and more people contract Omicron?
It's very hard to get staff right now, especially in this kind of setting, because no one really wants to be around people who have COVID, obviously, because they don't want to contract it themselves. But even the people that do start working at the centers, they're at risk also of contracting COVID. And then when they get COVID and we test them, we have to find new staff to overtake them so we don't have to close down the centers. So we always have to have extra people on board just in case, preparing for the worst.
Hey, Mark, you guys can do a PCR test in an hour. Times and other sites are getting delayed more and more, but you have to pay for that, about $350. And I wonder, what would you need in order to make that free for people?
We would need the government to provide these specific tests. They're very high priced. I don't think they're going to want to do it. But that's what we would need to do to make it free for the people. I would want to make it free, obviously, but since we have to pay rents, pay our staff, and pay especially for the tests, it's a very difficult thing to do. But we offer insurance receipts, which people are able to submit to their insurance companies to hopefully get reimbursed.
The way the system works over here in the UK, Mark, is that a lot of people are using lateral flow tests to confirm whether or not they do have COVID. Then if they do have that, they then go and get a PCR test. Should we be using the PCR tests a little bit in a slightly more targeted way to confirm kind of yes or no with some degree of certainty whether or not the lateral flow test is right, and then allow sequencing off it? Are we overusing PCR tests in New York and elsewhere when lateral flow tests would suffice?
Well, the thing with lateral flow tests is that it's a great test if you're symptomatic. But whereas if you're asymptomatic or just had recent exposures, the PCR will pick it up much faster, and it'll get the virus before it's symptomatic.
Hey, Mark, we really appreciate your time. We know you're super busy. It's obviously, I live in New York, so this is a near and dear problem to my heart. Mark Goldberg, thank you so much for your time and for all your effort, Rapid Test NYC CEO. All right, coming up, you got Bitcoin at 100,000. Bloomberg Intelligence sees that as a very good target resistance level as we head into 2022. Also, President Biden is kicking off his meeting with supply chain disruptions task force and private sector CEOs. They're going to talk about how to get goods moving. Let's listen in.
A year ago wasn't just in crisis. It wasn't working for working people. I told you that's the reason I ran. It's about time the middle class and working class people got a shot. Year after year, economic growth was too low, wages for the middle class were stagnant, and the number of people starting new small businesses was declining. Over this year, we've acted, from the American Rescue Plan to the bipartisan infrastructure law, to change this trajectory, to build an economy from the bottom up and the middle out, and to finally give, and by the way, when that occurs, wealthy people do very, very well. We're not trying to punish anybody. They do very well. Working people in this country, the wages and benefits they deserve, is about time they start to see it. To create an economy with more innovation and faster growth. And we're making progress. We got a way to go. We're making progress. Still, top of mind for me is what is top of mind for so many families, the pinch of prices and the cost. Look, addressing these costs has been and will continue to be my top priority the entire administration. And the way to do this is not to slow down our economic turnaround, not to step back from all this progress, but to build on it. We can and we will address prices by expanding productivity capacity in our economy so we move more goods to market, get more Americans working, encouraging more investments in innovation, and making sure American consumers see those benefits at the store and at the pump when they go to fill up their cars. Let me describe 3 specific areas I'm focusing on. First, supply chains. And I owe a lot to the people, the business people on this call, on this Zoom. Earlier this fall, we heard a lot of dire warnings about supply chain problems leading to a crisis around the holidays. So we acted. A lot of recommendations of the people that you see on the screen here. I wish we were all able to do this in person. We brought together business and labor leaders to solve problems. And the much predicted crisis didn't occur. Packages are moving. Gifts are being delivered. Shelves are not empty. Experts in this field look at 2 statistics for retail inventories, which is how many good retailers have on hand, and on-shelf availability, which measures how many goods are actually on the shelves there to be purchased. Today, retail inventories are up 3% from last year. Inventories are healthy, and on-shelf availability before the pandemic was about 91%. Today, it's at 90%. 90%. I'm sure you can go and find some shelf where it's empty because a particular sort of gifts are very popular. I don't know. But 90% availability. And delivery times this season for FedEx, UPS, and the U.S. Postal Service are faster than before the pandemic, even as Americans have purchased a record amount of goods. This is in part due to the progress we've made at our nation's ports, which are now moving historic amounts of goods. You know, after working with our administration, the ports of Los Angeles and Long Beach have nearly cut in half the number of those great big containers you see sitting on a dock for more than 8 days. This is striking progress since November. In fact, right now, the number of containers moving through our ports is higher than ever. It's because we've sped up, because when I sat down and talked with the folks running the ports and the longshoremen, they agreed to speed up every step in the process. The ports, the trains, the trucking. My bipartisan infrastructure law, there's $17 billion to speed up and modernize our ports. And tomorrow, the Department of Transportation is going to announce over $200 million in grants to ports nationwide. And we're making significant investment in freight rail as well. And we're also working to unstick bottlenecks between the ports and the stores by getting more trucks moving all around the country. We've heard a lot about the need for more truck drivers, and it's real. And we've gotten to work to address that. For example, I see Marty Walsh, my labor secretary. Marty, you've done a hell of a job, pal, cutting the red tape so that companies can set up registered apprenticeships for truck drivers in 2 days instead of 2 months, which it was before you took over. These apprenticeships are going to help new drivers get trained better and faster and help companies retain drivers in a field that has a lot of turnover. So I'm eager to hear about the new partnerships with trucking companies and states to get more truckers on the road and into good-paying jobs. We also need to build resilience into our supply chains. We can never again be left vulnerable the way we were in the early days of COVID-19. One important way to do this is to make more things here in America. That has been a goal of mine since day one of my administration. We've added more than 300,000 U.S. manufacturing jobs, more than 300,000 added since I took office on January 20th. And we're going to keep at it because the more of what we buy in America should be also made in America. The second area protecting American consumers. Take gas prices. Months ago, I saw oil production wasn't keeping up with the demand as the world started to get moving again, which could drive up prices at the expense of our consumers. That's why I work with international partners to coordinate the release of oil from our oil reserves and theirs. Now, gas prices are coming down, more than 10 cents a gallon nationally. Gas prices in 21 states now are at their historic averages before the pandemic, historic averages. That's good news for Americans hitting the road this week. But beyond energy, we need to make sure that there's a robust competition across industries. Competing is what encourages companies to innovate, encourages them to invest, to build, and offer lower prices. I'm going to be convening my competition council earlier next year, in January, to keep pushing for more bold action because healthy competition is a hallmark of healthy capitalism. Thirdly, I'm working to reduce the largest cost burdening households and budgets. And the biggest weapon, in our arsenal. It's my Build Back Better Act, which will reduce what families have to pay for prescription drugs, for health care, for child care, and so much more. The bill is paid fully paid for. It won't increase the deficit. And nobody making less than $400,000 a year will pay a penny more in federal taxes. Top economic forecasters from Wall Street firms reinforced just this week that failing to act on the Build Back Better plan will mean less economic growth this year. Let me say it again. Not a liberal think tank, Wall Street. Failing to make these investments is going to slow growth, not increase it. Look, if we in fact seize this opportunity, I think we can lower costs for families, get even more people working, and lower price pressures long term. And we're going to keep working on all these fronts because it is so clearly what American families need right now. I'm going to now turn this over. There's much more to say, but maybe I've already said too much. I want to have an interchange with you guys. But now I want to turn it over to Brian Deese to begin this meeting. We'll move, and I may have some questions in fairness.
Great. Thank you, Mr. President. And we will move immediately into the first section of the agenda to focus on ports and logistics, the progress made, and additional steps to go forward. And we'll hear from John Porcari, Fred Smith, and Chris Connor, and then turn the floor for some questions. So, John, over to you.
Thank you, Brian. Mr. President, we're making real and sustained progress at the ports. There's increased fluidity and velocity in the goods movement. As you reported, Los Angeles and Long Beach, which together are 40% of the imports to America, are moving record volumes of goods. And the percentage of the number of long-dwelling containers, the ones that have been there 8 days or more, has been cut in half. At the Port of Long Beach since mid-October, the dwell times for those containers has dropped from 12 days to 5 days. That's 140% improvement. And in Los Angeles, from 9 days to 4 days, 125% improvement. We are holding Monday, Wednesday, Friday morning action group meetings with leadership of the ports, with labor, the ocean carriers, terminal operators, railroads, and truckers to work through problems in real time and talk to each other through these problems. We're moving towards 24/7 operations at the ports. One of the ocean carriers, CMA CGM, has opened their gates 24/7 at their marine terminal and put an incentive of $100 per container for moving the containers that have been there 0 to 8 days, and $200 to do it nights and weekends. The two
To get them off the port. On the port on a truck or train or heading to a warehouse or something. Is that the idea?
That's exactly right, sir. That's to increase the velocity of the containers and move them as quickly as they hit the docks.
Okay.
The two railroads, BNSF.
You've been listening to President Biden and Brian Deese as well as they convene the Supply Chain Disruption Council. President Biden saying a few things. One, that the Transportation Department will announce some grants to ports tomorrow. He signaled it would be about $200 million in grants nationwide. He continues to say that addressing these price increases remains his top priority. He talks about getting robust competition across industries, and that he will convene a competition council in January. He also takes a little bit of a victory lap there on gasoline prices that are coming down nationally. We'll bring you any headlines and any updates as they cross. Guy?
Let's talk about where we are with the markets, get you an update as we count you down to the European close this Wednesday. This is the price action we're looking at. We're around 29 minutes to go until the end of the day. That may drag a little bit because, to be honest, today has not been the most riveting day for equity markets. Volume is now starting to fade firmly as we head into the holidays, and I think a lot of people have stepped away from this market. COVID clearly probably the bigger narrative. We are watching what is happening there very closely, but the markets, do seem to be now getting to the point where they're starting to look through it, and some of the data out of South Africa, maybe some of the data out of the UK, starting to confirm that maybe we're not seeing the effect that we thought we would from this wave. So the Stock 600 is up